Alright guys, welcome back to Wealth and Travel on a Dime. Today we're going to go over the whole income dividend portfolio. Now, let's get out of the way right off. I'm not a financial advisor. I'm just some guy on YouTube working towards financial independence. And I just want to let you guys know what we're doing and be transparent. Please don't copy what we do. Please don't invest in the things we do. Do your own research. We are not financial advisors. So now that that's out there, if you do this, it's your own fault. All right. Moving forward, everything I'm going to talk about today, from brokerages to the dividend tracker I use, is all going to be in the description below and the first pinned comment. So if you actually need to get in these resources, there's links there. Also, I want to mention that this video is brought to you by Connecten Internet, but more on that later. Now, let's get into the nitty-gritty of this. I do need to tell you guys right off the bat that we are somewhat of high yield chasing in this because this is a hedge. So for those of you who don't know, our strategy is simple. Somewhere between 2/3 and 3/4 will be index funds for us. But we're building this income high yield dividend portfolio as a hedge. Other people use bonds, but that's not how we're building ours out. The point of this is if the market's down and we don't want to sell, or we want to sell at a discounted rate on our index funds, this will cover our core bills. This will pay our taxes. This will pay our basic everyday bills, our car insurance, our home insurance. We want to build this out to have this income flowing in. Now, this income will not be as much as, say, index funds like the S&P 500. I mean, it has bull case years where it goes up 20%. You know, the average long term on it's 10% now. It's not going to do that, and that's not what we're trying to do. This is when the market goes crazy and nobody wants to sell, this is still spitting that income. And the beauty of it is, on the years the index funds are doing good, it's still spitting income. So just a different way to hedge our portfolio. Now, I'm going to take you into Dividend Tracker here, and I'm going to explain why before we even go in. I would take you into my brokerages, but then I'd have to go two different places. All right, because we have two closed-end funds that they don't sell on Robinhood over in our Fidelity brokerage. All right, and those are set for dividend reinvestment, and I'll go over that when we get in here. But the rest of them are over at Robinhood. Now, I know some of you may not like Robinhood, but there's reasons for this that will become clear in future videos. Now, let's go ahead and jump the screen and I'll show you exactly what we're holding in our $49,376 dividend portfolio. All right, so now we're recording, and as you can see, the portfolio value is $49,376.13. And if I pull down and go to the very bottom here on the dividend tracker, which, as I said, you can go down and check this out on the links below the video, you'll see that we have a 14% yield, and a yield on cost it's almost 15%. Our May income is projected to be $601, and our annual income is $7,222. Now, I want to say that this is not the paid version of this app. You will get much better results by having the paid version, and there is obviously a discount code for it if you are interested. But let's get into the numbers. The only thing I want to mention before I flip down is you look at max time, how it's gone down and then back up. Not only is that market, but that's also because we had some loss leaders we got rid of. All right, so we're going to start off, and we're going here by shares or value, whatever you want to take it. The equity is pretty simple. You can see here we've got SVOL on top with the most equity at 5,587. Now, this thing pays 15.69 dividend, all right? So we're getting almost a 16% dividend from our biggest position right off the bat. And it also, the way they do these is it's almost like a 30 cent every single month. 90% of the time that I've seen, it's come from actual yield that they've gotten. But they do a tax efficient return of capital on this, so you should know that. Now our next one down is Acre. All right. And for those of you who don't know, Acre is one of those things where it can be a good position, but unfortunately the commercial market has gotten destroyed. So when you're looking at Ares commercial real estate, they have gone downhill fast. And right now we're selling calls on this position, and I'm not afraid to get called away and move this money somewhere else. Because I don't really, it's not that I don't believe in the position. I know they'll be around long term, but we have basically taken a bath on share, price going down, and then they did a dividend cut recently, 25%. So that brings the dividend yield down closer to about 10 to 12%. It's really not a position I want to be in, but at the same time, if I can keep selling calls on it until it gets called away, collecting that premium, I will get my money back. But that would be, in this case, considered a loss leader. The higher yield it has moves our account, even though we're losing a little bit of the NAV. So my next one is a tried and true, which is JEPI. Everybody knows what JEPI is, JP Morgan Equity Premium Income. Now, their yield has gone down over time, but their share price has appreciated, so you can't complain. All right, next up is Realty Income. Once again, another one everybody knows. I don't mind being in this position, but the yield is quite low, so I really would not mind if it got called away. I am in a put right now, and then I'm going to try and average down because the share price has dropped since I had bought it. The yield has gone up. So take it as it is. Still a pretty good position. I don't mind staying in it. I don't mind the shares getting called away and moving it in something a little higher. USOI. Now this is Credit Suisse, and I want you to understand this is a loss leader. This really is, which means the NAV goes down. But I've had this thing so far and rode it through all the oil booms and busts. I have made so much money off this, and I'm just basically going to let it finish paying itself off and keep it. It's not going to hurt anything. The price of oil makes this thing move, so it'll climb another 10 or 12% the next time we go into an oil boom. So you just kind of got to ride these ones out. I would definitely say this is not for most investors. Next is JEPQ, which is a newer fund, but it has been performing amazing in this bull run. The dividend yield on this thing at like 10% is what it states here. But my yield on cost is 11.09, so I do not complain about JEPQ. It's one of my favorite positions, and I plan to build it bigger. Next will be FEPI, which is Rex, Fang, and Innovation. Now, this one is one of those really high yielding, all right? But the difference is when you look at it, the 23.83% yield sounds insane. But it's also holding its share price. So at this point, I'm waiting to see what happens when we go bear, when we're not, racing to new highs all the time. But if it holds its premium even close at this rate, I'm going to definitely put a lot more money in this. Now next is Hercules Capital. And this thing has printed me money. Literally printed me money. Everybody talked a bunch of trash about this company because they give short-term loans or principal loans and get a piece of the business to companies that range from like DoorDash and all those. Everybody said they were going to go under giving those loans, but they have grown and grown and grown, and they are pulling in right now an 8.26 dividend yield, but I actually have a yield on cost of 10.47 because I bought at such a low point. I would gladly put more money into Hercules. All right, next one is SPYI. Now this is going to be a little bit more tax efficient from Neos. They really do try to keep their NAV steady, and they try to keep their tax efficient strategy going. So when you are invested with Neos, they are definitely looking at both those, which is great for keeping the principal and not being a loss leader. Now it's currently yielding 11.75, but I actually have a yield on cost of $12.08. So definitely a great fund. And here comes the problem child. All right. So those of you who don't know, Arbor Realty Trust is a blockbuster company. They are doing all kinds of excellent things. With that said, they've had 2 short seller attacks. If you don't know what that means, basically companies are out there short selling them. In other words, betting that they're going to go down, and then they release reports which are fictitious or are exploiting things that they twist around to make people want to get scared and sell their shares, or to drive the value of the company down. That way they profit. So essentially, this is a stock that's under attack. The value's been driven down, and it's all kinds of all over the place. Now, if you look at it, it has a 12.38% dividend yield. All right. But in order to make up for the little bit of shares that have gone down for us, we are selling long-term covered calls on this and just waiting for this all to play out. Right now, they just keep getting attacked and keep getting attacked. So there's not much to do but ride it out. But with all the volatility in it, this would probably definitely be a stock I would stay away from until the water's clear. Next up is Ares Capital Corporation. Now, this is a monster, a behemoth taken care of in-house. They know how to do business, all right? I have made plenty of money off this, and them holding on to that 9% yield is actually amazing. Now, my cost base is almost a 10% yield, but still, this is a company that just prints money, and it can hold out in all market weathers. I really, really do like that company, and I think it's worth the money. Next is the BlackRock TCP Capital. Now, these were companies that were combined recently, and honestly, 12.62%, not bad. My yield on cost is 11.34, so you've seen some price movement, obviously, but when companies get bought or combined, then things like that happen. So next up, FSK. All right, so FSK is one of the bigger in their group of stocks, but I bought this in my Roth like way back in the day, and it just blew up back in like 2021. It blew up, and I was like, okay, I see this. And I've quietly just been buying it. I don't really talk to people about it. No one really talks about it, but it's got a 12.78 yield. Mine is a 13.12 on cost, but it's just made me money. I've had zero complaints. It just sits over there and does its thing, the same way the next one does. And people get scared of the word in there because it says midstream partner, because that means a K1. And if you don't know about K1s, it is murder on taxes. My wife made me sell all my midstream partners that have K1s because you basically have to wait till the last day to do your taxes because the businesses have to do theirs first and send you your K1. But Hess Midstream no longer has a K1. Honestly, it just makes money. And when you look at the yield, even though it's been beat up some, 7.36 is a solid yield. It's a company that doesn't really have to do anything except transport oil and gas through their lines, and they just get paid to do it. It's just a cash generating machine that's very efficient in their structure of the partnership. Now, my yield on cost is 8.82%, which makes it a really good holding for me, and I really will never sell it because people can say whatever they want. Gas and oil long term cannot go anywhere as far as these things moving them, because even if we in the US go away from it somehow in some way, which we're still way off from that, we will still be exporting it. So it's a real world numbers to know that this is the business to be in, not the front or the back. Next up, Blue Owl Capital. This thing has become a juggernaut over time. All right, honestly, it has just grown exponentially through all this bad environment. Everybody's like real estate this, business companies that. When you're trying to give money to companies to do different things, this is a hard environment to do it in. And now with a yield of 9%, my yield on cost is 10.76% on this. I will never sell these shares. This company is eating it up. All right, let's talk about Coney, which is a yield max fund. And you hear yield max and everybody screams and runs away and says, you're going to lose all your money. Your NAV's going to be gone. Well, to be fair, Coney has actually held pretty steady for us. And I've been collecting an insane amount of dividend income off this. I don't have a huge position in it because I'm not willing to risk it at that point. But what I want to show you here is the yield on cost for it right now is 126.47%, and the yield on my cost is 133%. Now, don't go out and buy this because these stupid numbers. If you want to go put $100 in it or something, that's fine. But do not put your whole portfolio in this. Keep it below 2% of your whole portfolio, I would say. But the reality is this thing's making money. Tomorrow it could be not making money, and you have to be okay with that. That's why it's such a smaller percentage of our portfolio. And I will not be buying anymore. I'm just letting this roll. Next is Main Street Capital, and it's a grower and a shower. It shows you what it can do. Honestly, you just have to look at the difference of the current dividend yield and my yield on cost, because 5.91%, that's a pretty good basic dividend for a very big growing company. But the 7.2% shows you how much it's grown on my yield on cost. This thing has been amazing at making money, and it continues to go forward doing it, and it doesn't dilute down the shares like other companies like Realty Income. So currently I have no complaints on that. Next one, same oil kind of thing as Hess, is KMI, which is Kinder Morgan. Depending upon where you live, you may see their lines out in the fields. You may see their trucks running around servicing stuff. This company is once again just an income printing company. It doesn't, do amazing growth things, and it really holds its value decently, not perfectly though. That said, it's paying a 5.84%, and then my yield on cost is 6.67, which makes it a pretty good, solid baseline stock. Next is Altria Group. Now, I don't have to really, explain what this business does. Some people put it in with, stocks you shouldn't touch because their future proofing is not real good, but it does print money, and it has for years. So I have a smaller holding in it, but that allows me to get a 8.75 is my yield on cost. 8.51 is the actual, based on share price now, dividend yield. Still a solid number. All right, the next two, CRF and CLM, are over in Fidelity. Now, the reason I have these, and everybody's going to freak out because they're going to say the share price goes down. Okay, that's fair. But what you have to understand is, if you look at my yield on cost, 18.25 and 17.45, and the yield on cost that if you just bought them now, all right, it's important to understand that these are your dividend yields. So if it's going down, let's say, 10% a year, you're still above here, but that's not the real story of this. There's two other ways to make money with these funds. The number one way is to get reinvested on the special DRIP program. And what that does is you buy at the NAV. Now, those of you who don't understand closed-end funds, there's two prices. So you may see here it says $7.13 and $7.14 as the share price. But if you take and go look at the NAV, it's lower than that. So it may be $6.50 right now. It may be $6.75. But when the monthly dividend gets paid, it gets used to buy more stock of this and gets reinvested down at the NAV. So you're getting anywhere from an extra 5 to 10% over the year from doing that. So basically, I bought enough shares of each of these so they can reinvest every month. They're buying more shares, full shares, and getting them at the NAV and getting this dividend. Now, there is another way. It's called a rights offering. You can sell all your shares before the rights offering and then buy back in at the rights offering at a lower price, but I don't mess with that. The point of this is this just keeps rolling. It's currently buying about $10 or $11 worth every dividend and then buying at that lower price, and it just keeps growing. And I'm just going to leave it alone and let it grow now that it's buying a full share every month. What that will do is allow it to grow without me having to produce more capital, and it will just keep going. Now, when I'm ready to use it in the future, I'll just sell the whole bulk lot, and it will have grown exponentially, and I can take it and just sell it and put it into something else. So this is an autopilot play. This allows it just to do its thing. Now, we move down to Barings BDC. This one could go either way. Currently, it's doing all right, but I do watch it. I don't know that long term they're going to be able to keep it up much longer under the pressure of interest rates. But if they do, this thing should skyrocket, and that's why I'm willing to stay in it. My yield on cost is 11%. Right now it's paying $10.50 to the normal share price for dividend yield. So that's pretty good. Now, Another yield max fund, NVDY, which is their NVIDIA options. This one has printed money, so I will leave it in here. Once again, do not put your money in these funds if it's any kind of large allocation, because you could wake up tomorrow and it be gone. Now, the current yield on cost is 54% a year. My yield on cost is 69.19% a year. So this fund has actually gone up, whereas a lot of yield max funds over time go down as they pay out giant dividends. Okay, moving on, Horizon. Now, Horizon is one of them businesses that they have their fingers into so many different things. It's almost hard to track all the stuff they're getting into. But with a almost 11% yield on cost and a 11.42%, you can see that there's been some price movements down, but that is literally because of the interest rate environment we're in. There isn't anything fundamentally wrong with the company that I can see, so I'm just going to hold it long term and let it go. Now, next is Pennant Park Floating Rate Capital. This company can do well, but once again, we're in an interest rate hike, and it's still paying solidly, and it still looks good across the board. So currently, I'm going to stay with this long term. I'm not going to grow the position. I'm just holding. Now, I have an 11.40% yield on cost. It pays a 10.90% right now at the current share price. So those are beautiful numbers. It's not a great mover as far as growth, but it pays good and continuously. Now, Rhythm Capital. This was a play that I was actually really worried about, and it just blew up. So I'm super happy with how it turned out. We've got a 12% on yield on cost, and 8.72% is at the current share price. So that can show you how much it's grown just since I owned it. So it's definitely moving. Okay, PBR. This is to do with oil, mining, all kinds of things, and it's in another country. I would not suggest getting into this. It does pay good, and it does a bunch of special dividends. So on the books, for a dividend investor, it looks really nice. But man, it bounces like a ping pong ball depending upon what's going on in the market. So I would be careful not to get too much into this one, especially because there's other tax penalties you have to look at for owning companies that are outside the U.S. This is one you need to think about. And it's also a lot of the things it owns is in Brazil, and you can remember how much chaos happens in Brazil. So I have 11.63. It's currently paying 11.5% dividend on the share price now. And like I said, this is probably one I would stay away from. I'm definitely not adding anything to this. Ready Capital is next. Now, this little guy has just tried to buck the system and pretty much got poo-pooed on. If interest rates drop, they'll probably be able to recover, but it's probably going to be a while. And I'm content just to sit back and let it happen. You know what I mean? So currently, I'm getting 9.48% on my yield on cost. It's paying 13.78 because there's been some share price drop, which increased the dividend yield versus the share price. Decent company. Oak Tree Specialty Lending, not a grower, just a normal everyday company that's gotten a little bit beat up too. As you see, a lot of these ones, that involve lending and capital, interest rates beat on them. So I have 10.5% yield on this one, and 11.36 is what you'll get if you were to buy it. Triple Point Venture. Now, for the new investors, I probably would not mess with this too much because it's a venture capital company, and they can do some wild things, and there can be movements in their stock prices that don't make any sense that come out of the blue. I'm not growing this position at all. I am just chilling in it, collecting my 13.5%. The yield on cost now, because the share price has gone down, is 17%. Not one I would go jump to get into. Okay, so the next one is YMAX. And for a yield max fund, if I was going to go invest in a yield max fund, this would probably be the one I would get into, because this one does the Magnificent Seven, which is basically some of the biggest stocks in the S&P 500. And what that does is it allows you to diversify. So they're basically taking a bunch of their funds for the Magnificent Seven, and they're balancing them by which ones are doing the best at the time. Now, what this allows them to do is kind of yield more on the ones that are doing well, which pays you more. Now, the thing is, they're cutting the volatility of some of their other funds by doing this, which gives you a little bit more of a steady payout. Now, the flip of that, like Coney has 130%, it's not in this. So as you can see, the yield's looking to be, whether it's my cost basis or the regular yield, it's 38% is what they're averaging right now. It does change month to month. But if I was going to get into one, I would diversify. Much like index funds are better than stocks, this is better to have a fund of funds if you're going to get into this play. But once again, your NAV could go down. And then every dividend that gets paid every month, the NAV drops and then recovers. But it could drop and not recover as much and have NAV erosion if you're not careful. Okay, TORM. So TORM is amazing for growth for me, but I've seen times that it fell through the floor. It literally fell through the floor. So I have a yield of 21% because I bought it on one of them dips and I rode the bad weather out and it was hard to do. But the new yield is 15%, so you can see the share appreciation that has gone down here. So not one for the faint of heart, not one I would tell you guys to get into. Next is Blackstone Secure Lending. Once again, interest rate beat up. I mean, they're still up, but interest rates are holding them back from doing much right now. 11.3% yield on cost, 10% yield if you're just coming in the door at the current share price. Not bad. Capital Southwest. These boys have pulled off some miracles in this high interest rate, era we're in now. I got in and I'm getting 12%. But even through that, they've grown enough that the new yield is 9.6%. I would definitely buy more Capital Southwest if I got the opportunity. I think that they are going places, and I think this is just the start. All right, next one is QQQI, which is Neos. They're selling calls on the QQQ. This one in the current market, I think, is going to do really well. But the good thing is, like I talked about, the Neos guys are worried about tax efficiency and your share price. You know what I mean? Your NAV. They don't want NAV erosion. They don't want it going down the hill. So this one on my cost basis and the price is almost the same, 13.9, 13.8. But you're pulling in almost a 14%. And once again, they try to keep the monthly numbers pretty close. And I'll honestly say they've done a real good job. We got to watch the bear market, but them thinking about tax efficiency is important. Funds that talk about that is something you guys should be paying attention to. All right, moving on. TRP, which is TC Energy. Now, TC Energy is one that actually my wife had a play in. She has been holding it for a long time, and it's gone down, it's gone up, it's all over the place. But it has gone down as of recently because borrowing money is more expensive. And if you're in the energy sector, you're borrowing money. So you see I have a 5.6% yield, and now they're at 7.21, which means the share price has dropped. So once again, this is a play that you have to be willing to ride out the ups and downs, but they are consistent payers, and they do exactly what they're supposed to do, which is create money. HIPS. All right, a lot of people hate on this stock, and I'm not exactly sure why that is. Realistically, this is kind of a play on midstream and various different oils, other things, and it puts it all into one portfolio. Now, if you want to see one that just basically pays, the share price may go up and down, but it generally stays in a little marker there, then this is what you want. Because I have a 10.80 yield on cost, and it's 10% now. So the share price isn't really moving on this one. It doesn't do a whole lot. It just kind of prints money, which is what this portfolio is about. Next one is a hedge play, and I would probably stay out of this one because it has a high expense ratio, and while it does pay well, I wouldn't hold my breath about it yet. It's not really tested long enough. So the Volatility Shares Trust here, ZIVB, is a newer one, and I'm on for the ride, but I won't put any more capital in. I'm just on for the ride. I'm watching. So this one on my yield on cost is paying 24.56, which the new yield is 23.15 based on share price. So the share price has gone up. Now in this kind of fund, that's what you want to see. But we have to wait and see what happens the first time they lower rates. This thing may crater. So it's important not to get into this one unless you're just testing it on a very small dollar amount. Sixth Street Specialty Lending. Now, once again, just a printer. I mean, honestly, this is in here for diversification more than anything. But as you can see, share price doesn't move a whole lot on this one. They're good at just keeping their capital valued up and paying a fair premium at 8.9, 8.6%. Can't complain. MSFO is another yield max play. I have very little money in this. I think that this one will do good, but I'm not going to add no more money to it because I don't want to take a chance on NAV erosion. So you could call this a loss leader if this little bit of money starts to go down, but I'm getting 34% on my yield on cost, and it's paying 31% currently. Now, it is a variable dividend, so that could go up and down monthly. You just have to ride it out. Currently, I'm just holding. PennyMac Mortgage Investment Company. So PMT is probably one of the least volatile stocks that I have, to be honest with you. This thing doesn't do anything. It just sits there like a big turd. I don't know that it's a great investment for what it does, and I don't know that it's a bad investment. It's a very boring investment. Nobody looks at it. I have 11.42%, and now it's 10.64. I've held it for quite a while. It just sits there like a big lump paying me money, so I don't care. So AMDY, which is another yield max fund, and it is carrying out a 29% yield on my cost and a 35. So you see what I was talking about? Yield max can eat the NAV down and erode, okay? So at the time I bought this, it had already been moving up a bunch, and now it's cooled off some, and they're not getting as good a premium, and it's burning down the NAV. So this is a perfect example of why you shouldn't get in these yield max funds, and if you are, you should get in one of their funds like YMAG. All right. Next up, I have a super small position in all of these, but I'm going to be growing them in the future. Obviously, SCHD is just a dividend equity fund. Everybody knows SCHD pretty much, and it pays at basically 3%. Let's put it that way. Now, Gain. Gain is people either love Gain or they hate it. I mean, Gladstone name is good, but at the same time, it's had its problems. But at 6.68%, it's just a very small holding I hold, and I will probably grow it a little bit. All right. OMF. I went back and forth on this stock a million times. I bought one shares just to force myself to keep looking at it. Now, I have drove through local cities and seen this company in malls. All right. So they're out there, on the streets actually doing it. This is a real world place, not somebody that's sitting in some high rise. They're on the streets, putting money out, doing things financially, messing with kind of like an insurance kind of thing, and also messing with regular financing and getting into multiple of their business. This thing pays $1 every month for every share, and they have for a long time. Now, there's not a lot of volatility. It's pretty much just a rock solid. But the only fear I have is, are retail walk-in locations the best business model anymore now that we're going to everything online? So I really want 100 shares of this. That way every quarter it's printing $100. So if you could have $100 every quarter from 100 shares, that's $400 a year in dividends. It's 9.40% yield on cost. 8.32 is the current yield. As you see, it's gone up just a little bit. I'm just saying I could hold 100 shares of that, and I could also probably sell options on that monthly. So it's definitely an option. Next is Buck. And Buck is created to just basically sit there like a big dummy and pay. As you can see by the prices, Simplify is just trying to build a stable income source with a pretty basic payout average and hold it. So nothing wrong with Buck. I don't think it's a massive show off one. And if you're trying to build a high yield, that's probably what you should add in later on when you're trying to diversify. And the last one, do not get into this. I don't know how many times I've got to say this, but Clip can pay you a lot of money. You will pay with the NAV erosion, but that Crane Shares Trust, A, you got taxation on it, but B, the big problem is you have NAV erosion. Now, will you make enough to cover your NAV erosion? Yes, but when you look at 34% or 42% as it is now, then the problem is you can see right there how much the price has dropped. All right, so if you drop 10% or 15% in a year, then you're really only making 15%. You might as well go get into one of these other funds. Do not put money in Clip. You can do what you want. It's your money, but I'm just going to tell you, you're not getting the return you think you're getting. Now, I'm already in for a penny, in for a pound. That's the way I look at it. I have a few bucks literally in this because I was smart enough to take a big payday and get out when I was breaking even. And this is just a few dollars I had left that didn't sell as a whole share. So I won't be getting any more of this, and I really would suggest all of you get out of that if you are in it, or stay away from it. Now, if we roll back up, I want you guys to understand that we want to build this up to have $12,000 by the end of the year of income, or close. And then next year, we're going to start living off this. And then we're going to have other businesses set up to keep injecting money in this, that those businesses are literally only to inject money in this portfolio. We still are building our index funds, and I think that once you see how our whole portfolio turns out, it will really make more sense. I just wanted to get this one to you guys to see it because this is the one everybody asks about. I do not think you should start an income portfolio like this until you're a year or 2 or 3, depending on how long it's going to take you to build it up, before retirement, because this is not tax efficient. You have to pay taxes on all these unless it's in a retirement account. We are trying to use this for financial independence and a kind of semi-retirement early. So we're using this next year for the income. If we were just holding it year after year, that doesn't make sense. You might as well just hold the S&P 500 or an index fund of some kind and collect, a 1% dividend, and you don't have to pay taxes on any of that as it grows until you sell something. And then you could convert a portion of that into income, which is way more efficient. It honestly is. But in retirement, another thing a lot of people don't talk about is if you need a loan for something, which I don't know what you would, you can take those dividend payments to the bank and they count as income. It's something they can strategically hold. Now, you can take your portfolio in and fight with them and say, I have this, and they may give you the loan. But if you walk in with a portfolio and they can see dividends being paid that have a value like a paycheck, then they're quicker to want to give you a loan. It's just a little bit of upside. But like I said, this is to protect us in a down market or just pay our bills, which what starts next year is basically $1,000 every month that goes out to pay our bills. So all the other money we make and put into investments and do things with is ours. This will pay our bills. All right, so now that we've got to go through all the numbers here on the Google Pixel tablet, and I've shared them all with you, I want to know what you guys think. Is this strategy something you see as value? Now, I know a lot of people are big into doing like the bonds and mixing that in, but I would ask you to go ahead and go back test the bonds. Go look at what bonds have done in down markets even. Go to 2020 dip and check out what bonds did. Now, very rarely do companies cut their dividend. Now, some of these funds here with covered calls, the dividend probably would go down in a heavy bear market, or a heavy drop is going to see losses in everything. But as long as you're still getting income rolling in, it's really a good option. Now, there is a taxation side. All right, but if you are a married couple, unless you're pulling like over $80,000 a year, you're not going to move into any sizable tax bracket. I can guarantee you that. So think about things like this for your retirement future, because what a lot of people don't realize is I'm getting 14-15% on this. Well, if the 4% rule says I can pull $4,000 off every $100,000, how many $100,000 do I need? On this portfolio, on $100,000, I'm getting $14,000. So how many $100,000 do I need to retire? You think about the numbers, and it'll quickly change your mind. And there's also the argument that you could take $10,000 and reinvest the other $4,000 back into the portfolio to grow it more every year. So you basically are getting double, if not triple, the standard 4% rule. Food for thought. Let me know down in the comments what you guys think. Are you guys dividend investors? Do you see the value in a play like this? I don't think you should have everything in income funds. I think that's a bad idea. I am a believer in index funds. It is the smart, slow, and strategic way to do it. And I think that if you have 2/3 index, 1/3 income, you've got the perfect balance. You could even go as far as to say over time, because it's going to grow, it's going to end up 3/4 index and 1/4 income portfolio. Because we know how much index funds can boom and bust and grow. So as you may start with 1/3 here and 2/3 here, it's more than likely going to grow to where you have 3/4 here, 1/4 here, because of the way index funds grow and move. So let me know down in the comments what you think. As I said, everything here will be put down in the comments, and now it's time to hear from our sponsor. So for those of you who don't know, Connecten is a wireless internet provider that uses all 3 of the top major networks in the USA. That means AT&T, T-Mobile, Verizon. So you have the ability to have the best service wherever you are. Now in our home, we use it to stream, we use it to upload our YouTube videos and do all the normal things you would do in your home. But Connecten doesn't stop there because they have amazing equipment and it's a low power draw. Why that matters? Well, because for one, we're taking our tiny house off grid here. So power does matter in our future buildup, which is one of the reasons we chose them. The other is that we travel a lot. We like to go out on the road. And when we're out on the road, a simple power inverter that plugs into your cigarette lighter, very, very low wattage, usually around $20, can be had that you plug the unit into, and as you're going down the road, you've got power. Now, not only that, but we like to go places that there is no power or that the internet is no good. For example, have you ever used internet in a campground? They're always terrible, especially at night when everybody's trying to use it. Why not bring your own? Can your home internet do that? And with plans starting at a simple $69 a month, how can you go wrong? Think about it. You're saying, oh, I have T-Mobile home internet or I have Verizon home internet for this price. But what happens when there's too many people on that network? Are they going to let you change from T-Mobile to Verizon, from Verizon to AT&T? No, that's where Connecten comes in line. If you are van life, if you are traveling, if you're a person that wants to have internet no matter where you go, Connecten is for you. And with that said, I will put all the information in the description box below so you can go check it out for yourself. Now back to the video. All right, guys, we really appreciate you coming along with us. I will be doing more updates on this portfolio in the future. Every couple of months, I'll pop up with one. We'll talk about the value, if it's gone up or gone down, and our yield on cost as I move things around. More videos coming on investing and our portfolios. Missy's coming back in talking about indexing soon and how index funds can grow your wealth. And we will be doing all kinds of more videos on this, travel, and everything else to do with financial independence, retire early, and just living your life, your best life, and planning for the future. So with that said, if you haven't already, go down, hit subscribe, hit the notification bell so you see all of our upcoming videos. Make sure you leave us a like, and we will see you in the next video.